Are you interested in earning passive income? Well, today we're diving into the world of peer-to-peer lending, a unique way to make your money work for you. Stay tuned as we explore what P2P lending is, how it works, the potential rewards, and the risks you should be aware of. But before we begin, don't forget to hit that subscribe button below to stay updated with more financial insights and investment tips from our channel. What is peer-to-peer, P2P lending? Peer-to-peer lending, also known as marketplace lending, is a way of borrowing money where people and businesses ask for loans on websites. This means they don't go through traditional banks. Instead, they connect directly with people or groups who want to lend money. On these lending websites, borrowers put up requests for loans, and investors like individuals or organizations look at these requests and decide if they want to give money to these borrowers. They make this decision based on how much risk they are willing to take and how much profit they expect to make from the loan. P2P lending websites act as middlemen, helping people apply for loans, check their credit, and manage their loans. They use technology to make the process easier and match lenders with borrowers. These loans can be used for different things like combining debts, getting money for a small business, paying for school, or personal needs. P2P lending websites have to follow the rules of the country they are in. They must follow all the laws, especially the ones that protect borrowers and investors. These rules can be different in each country. Examples of P2P lending platforms. Lending Club is one of the biggest P2P lending websites in the United States. It provides personal loans, business loans, and the chance to refinance your car loan. Zopa is another popular P2P lending website in the United Kingdom. It helps people get personal loans and connects borrowers with investors. Aave is a decentralized P2P lending platform that works on the Ethereum blockchain. It lets people lend and borrow cryptocurrencies with interest rates that depend on how many people want to borrow and lend. Aave also has features like rewards for lending, quick loans, and borrowing with collateral. How does P2P lending work? Let's use an example to understand how P2P lending works. Imagine Bob needs $10,000 to bring together his debts. He goes to a P2P lending website and fills out a form with his financial information and the reason for the loan. The website checks how reliable Bob is for repaying the loan and then puts his request on the site. A user on the website, Alice, reads Bob's loan request and decides to give $1,000 because it fits with how she wants to invest her money. More people do the same, and when enough lenders join in, Bob gets the full $10,000. Now, Bob starts repaying the loan each month. This payment includes the borrowed money, the principal, and some extra money, interest. The website divides this payment among all the lenders over time. This interest is what gives Alice and the other lenders a profit on their investment. Let's walk through the step-by-step process of P2P lending between Bob and Alice. Bob first applies for a $10,000 loan through a P2P lending website to consolidate his debts. The lending platform assesses Bob's creditworthiness by examining his financial information and the purpose of the loan. Afterward, Bob's loan request, including details like the loan amount, annual percentage rate, and the loan's purpose, is listed on the platform. Alice, an investor on the platform, reviews various loan listings and decides to contribute $1,000 to Bob's loan because it aligns with her investment strategy. Once additional lenders also fund the loan fully, Bob receives the requested $10,000. Bob then starts repaying the loan in monthly installments, covering both the principal amount borrowed and interest. The P2P lending network collects Bob's repayments and distributes them among the lenders, including Alice. Over time, Alice and other lenders earn a return on their investments through the interest payments made by Bob. Secured versus unsecured P2P lending. In the world of peer-to-peer lending, there are two different ways to lend money: secured and unsecured P2P lending. Secured P2P lending involves loans that are supported by things of value, like traditional assets such as houses or cars, as well as digital assets like cryptocurrencies, which are used as security. If a borrower can't pay back the loan, the lender can take and sell these assets to get their money back. On the other hand, unsecured P2P lending doesn't need any collateral. In this case, lenders decide if they want to lend money based on how trustworthy the borrower seems and their financial history. If the borrower can't pay back the loan, lenders often have to use legal processes to try to get their money back because there aren't any specific assets they can take. Both borrowers and lenders need to carefully think about the P2P platform's rules about collateral, interest rates, and risks when they're thinking about offering an unsecured loan. How to become a peer-to-peer lender. Before you become a peer-to-peer lender, it's important to find a P2P lending platform that matches your investment preferences. Look for platforms that have a good reputation, clear pricing details, and a track record of successful loan deals. Also, take time to understand the P2P lending rules in your country, as there might be specific requirements or licensing steps to follow. Once you've chosen a platform, create an account by providing the necessary information, like verifying your identity and sharing your banking details. After that, deposit the money you want to use for P2P lending into your account. This amount will serve as your capital for lending to others. Users can view loan listings on the website, where they can act as P2P lenders. These listings contain information about the borrowers, the purpose of the loans, the interest rates, and the level of risk involved. To make informed decisions, users should assess each listing based on their investment criteria and how much risk they can tolerate. Once they decide which loans to support, users should closely monitor their investments. This involves keeping track of due dates, interest earnings, and any delays or missed payments. Some platforms offer automated reinvestment options, allowing users to reinvest their repayments into new loans to potentially increase their profits. However, because peer-to-peer lending carries certain risks, like the possibility of borrowers not repaying their loans, investors should carefully study borrower profiles and loan details before deciding to lend their money. Can you make passive income by investing in P2P lending? P2P lending allows lenders to generate passive income. Lenders receive regular interest payments from borrowers, creating a source of passive cash flow. The amount of interest earned depends on factors like loan amount, interest rate, and borrower repayment behavior. Additionally, P2P lending platforms offer passive portfolio management. Once lenders select and fund loans, the platform takes care of loan servicing, payment collection, and distributing earnings to lenders. This means lenders can earn money without actively managing their loans, ensuring they receive their fair share of interest payments and borrower repayments. P2P lending platforms simplify investing with automated features. Auto-invest options automatically invest money in new loans based on lenders' preferences, removing the need for manual decisions. Lenders can also expand their loan portfolio and increase interest income by reinvesting repayments from borrowers. This compounding of earnings has the potential to grow their passive income over time. Risks associated with P2P lending. P2P lending involves several risks that lenders should be aware of. Firstly, there's the default risk, where borrowers may fail to repay their loans, causing lenders to lose both the principal amount and expected interest income. Additionally, P2P lenders often deal with borrowers of varying creditworthiness, which can result in credit risk, particularly when lending to high-risk individuals or businesses. Another risk is the lack of collateral, which means that in case of default, lenders may have few assets to recover. Furthermore, there's platform risk, wherein operational issues, financial instability, or the platform's failure can make it challenging for lenders to retrieve their funds. Lastly, market and economic instability can increase default rates and reduce the value of loans in the secondary market, posing further risks to lenders. Rewards offered by P2P lending. P2P lending offers advantages such as higher returns compared to traditional fixed-income investments, diversification across multiple loans to reduce risk, and passive income through regular interest payments. It also provides access to credit for borrowers who may not qualify for bank loans, promoting financial inclusion. Additionally, P2P lending platforms offer transparency and control for investors to select loans that match their risk tolerance and investment criteria. However, it's crucial for both lenders and borrowers to thoroughly understand and consider the associated risks. Strategies like diversification, caution, and choosing reputable platforms can help mitigate these risks effectively. If you found this video informative, give us a thumbs up, and don't forget to subscribe to our channel for more valuable content like this. Have you tried P2P lending? Share your experiences and questions in the comments section below.